Good afternoon. Ira Epstein of the Linn Associates with your SPDR ETF wrap-up. And this wrap-up is for Wednesday, and this is the 15th of April, 2020. So as we look at it, it's tax day, but you know it isn't. And as we look at the market behind me, it's an absolute sea of red. I mean, one market on this TLT, our 20-year plus Treasury instruments, that was higher. Everything else lower. Now, why? Economic data is finally hitting, and we're seeing the first real impact of COVID-19. And it's bleak. And we want it to be, how do I put this? Real. That's the right word. We know it's bleak out there. Look out your window if you live in a big city. There's no traffic. And that tells you there's no stores open, and there's no people moving around, and public transportation's at a crawl, and city budgets are going to heck. They're saying in Illinois, another $2.7 billion a budget deficit that we simply don't have. They're going to tax everybody to move out of here, and where do you go? Because if all the states get this, it's a real problem. So the Fed government, there's a lot of pressure on it. We know that. We know that earnings season, we didn't expect much there, but these numbers we're seeing, that's the reality of the situation. Now, how far do we go with these numbers before they start turning? Well, at the minimum, it's probably at the end of the quarter that we're in. Why not? None of the cities are opening. We're talking maybe some of the states will open, maybe could be 20 of them will reopen in some situation of graduated movement starting at the end of the month. We'll see. We'll see what the governors want to do, what the president wants to do, and you'll say, well, the president doesn't control it. No, he doesn't. The governors control their states. However, the simple fact is they need federal money, and that's what the president controls, period. Got it? So if the president controls that, now don't get me wrong, Congress can go around the president, but typically you don't want to be in that battleground because the next thing you need, he's not going to give it to you, and if he wins another 4 years, you have a real dilemma on your hand. So that's the reality of the situation. Let the numbers roll in. When people are back on the streets, they're going to only look better. What you're looking for is a low point. You can't know that you're at a low point until we start getting out of this situation. When I look at XLK, we had a market that rallied, almost got to a 62% correction yesterday, pulling back. There's a bit of a gap in here. Market might want to fill that. It would not be a surprise if it does. But as I said, when you get to 62% corrections, it's very hard to get back to this panic low. And I was of the camp when you were hanging around the 38%, we're going back there. That doesn't mean that you get up there and you still can't, but it gets harder. And as a market technician, I recognize that. When I look at what the trend is, it's up. You've got a pattern of, on the swing lines, higher lows. I've marked off the two recent ones with arrows, and certainly the higher highs. That's the definition of an uptrend. The market is over the 18-day moving average of closes. That defines bias. If the market's over it, I have upside bias. Under it, I have downside. I use bias to filter swing lines and other indicators to set up a trend. So it's like a domino. You get one thing going, does the other fit in, does the other fit in? And you're looking for them to fall so that, click, you got your trade at the end of it. Right now, the bulls are in control. We didn't quite make it to the resistance of the 100-day average. If you break here, I'll look for support at the 200-day simply because that's what it's been doing. So that I pay attention to. And where the market did run into resistance, we saw it before and we're seeing it, what it did yesterday, is that upper Bollinger Band. The market will trade within Bollinger Bands 95% of the time. Keep that in the back of your mind. So when you make a run to it from a lower level, that's a resistance point. And a lot depends, are you coming out of a thin band or where the bands are wider apart? I teach this in the charting course, so that's something you might want to consider. As you go in and you look at momentum, well, what do we have? We have both numbers over 80 today. Both numbers were over 80 Tuesday. Both numbers over 80 on Monday. That's called an embedded reading. Embedded means that you've converted the momentum from overbought to locking in a bull trend. It comes out of that locked up bull trend when the red line closes under 80. There's a rule that if it closes under 80 and the next day it jumps back where both are over, you're back into the embedded. But trust me, 90% of the time you lose it, you've lost it. It doesn't come back very often. And if it does, I have a set of rules for that. But in any case, so as long as that stays in, I'm looking for the trade to still be a buy at that number. When we come to SMH, which is the 25 index of the big semiconductors, we have a lower low, higher high pattern. The first thing is that's not as good looking a chart as we just did with the XLK. The second thing, the 200-day average is in play. We didn't make it up yesterday to the upper Bollinger Band, and there's big resistance between the upper Bollinger Band and the 100-day average of closes, but we're not trending. So I go here and I look for the other signal. The strongest signal on a chart is embedded, bearish or bullish. Do we have a bullish? Both numbers over 80, both numbers over 80, both numbers over 80. The answer is I have it. So I am still looking for the trade to be a buyer. There are numbers that if you get my end of the day spider and ETF video, I use another moving average in that as to where the market would be bought. I don't cover it here in these details. That's why people buy the spider video. They want to see everything where I'm saying, do this, do that. As we take a look at XLI, the industrial sector spider, we have divergence. You have a market with lower highs, lower lows. You have momentum that is turned down, and because the market is over the 18-day average of closes, you have bias up. So everything's sort of fighting each other. Let that one go is how I tell traders. I have the same thing in the energy sector. For the energy sector to turn bearish, I need to see this market close under 30.03. Right now, if it falls, I'm looking for support at that number. That is the line in the sand. That's what you call it, like the DMZ zone. If the market slips from a Bollinger Band, that's the support area. But we'll see what it does. But everything's fighting itself. Not the case in QQQ. It's bullish. You have the embedded reading. You have higher lows, higher highs. You went to the upper Bollinger Band. You pulled back today to the 100-day average. Remember, when you get over key moving averages, there's support on the way down. So if this market were to break tomorrow, I'm looking for support at 221. The number I don't want to see hit, there is none. I just don't want to see the red line close under 80 because it runs the hierarchy of the chart when it's embedded. On the EFA, the emerging market ETF, number one, I look right here. And I've lost any chart of an embedded reading. So I want no part of the long side. That's the first thing. Number two, if it stays lost tomorrow, it's probably going to make a retracement back to the 18-day average of closes. Number three, did it ever embed? So let's go to yesterday. Both numbers over 80, both over 80 the day before and over the day before. This is what you call a lost embedded slow stochastic trade. And I gave it that name. It's lengthy, but it makes sense. And what the pros will do is, I think, they'll try to press the market tomorrow and trying to get it down to this number. That's my guess on it. They'll throw in the towel if the slow stochastic reading, that red, pops back into the 80 tomorrow. In GLD, what I think's going on here is you got up to the upper Bollinger Band, the first challenge of it. You'll hear me say on my videos over and over, that's where I think pros have orders in, could be right in front of it, to be honest with you, to come out of the market. You don't have to be right on it. You can be close to it. What's close? Percentage away? I'll let you figure that one out. I have my own theory, but I say that in my subscriber videos. Higher lows, higher highs, embedded reading. This is still quite bullish. So I am looking with these pullbacks on each pullback, and I think I made that statement, I know I made it in my futures video the other day, that where you're getting caught in the metals is buying those rallies, those $30 to $50 rallies in the futures, and then they pop back on you and you're suddenly super defensive. You need to get to the point where the market allows you to buy the break instead of having to buy the rally to participate. I don't know if it'll hold or not, but that's what today offered. And that's what it seems to be offering on this. In the gold miners, you don't stay over the Bollinger Band, this black dashed line, more than 5% of the time. So as I teach it, you don't buy over Bollinger Bands. There's no rule other than that. I don't have my clients do it. Now I will watch very carefully in the morning. you're on the verge of losing the embedded reading if you open a couple of dollars, a buck lower. You got to be careful. So I'd like to see that. But if it keeps that embedded reading, I think the pros will start nibbling on the long side until it doesn't. In TLT, I don't look for much in the way of upside here. I think the market got the bid today off the terrible economic data, and traders went into a bit of a shock when they saw the New York number was the worst number the survey's ever seen. So everything is slowing down, which we expected. Fed numbers, everything's going to slow down, and the market got the bid. Now I'm looking for wherever that Bollinger Band is, and it's going to fall tomorrow. That's where I'm looking for the resistance to come in the market and the pros to step out. FXE, which is the euro, it went sideways. You've got the higher high, lower low. It's refusing to trend. When a market doesn't want to trend anymore, why be involved in it? All you can do is get whipped around. As I said, I'm doing my afternoon spider ETF. And what I do in that ETF, I think it's pretty fascinating. The idea here is I'm hoping you have your own trade ideas. These ETFs are not meant for somebody that doesn't understand the chart. It's going to be beyond them. But it's also not meant for the guy that's thinks he's the best pro in the world. I don't know that he'll like what I do. All right, I consider myself a good chartist. You know, a lot of people think I'm better than that. Some people think, nah, you're not. Okay, I can live with it. But if you're watching these videos, you think something. And I cover 27 charts on the main spiders and ETFs. I do it after 4 p.m. And the reason I do that is because the market doesn't open to 8:30 in the morning. I want you to see what I'm thinking about. And if you have access to the futures markets in any way, you know they open at 5. They're going to weigh on the market in some manner, way, shape, or form for the opening in the morning. But you get an idea. Are they validating things, not validating? These are all the categories that I cover and the different ones that I do. I've ordered another high definition camera for us to have webinars. So my subscribers will be invited into the webinars, and then once a month, once every 2 weeks, it'll be some number here because I love doing it. I love teaching. We'll review together. Everybody can come in, you're writing. I don't let you all talk because talking, what I have found, it's too hard. You can't hear anything unless they've come up with some new technology that I love. But I let you write me, and then I repeat what you've written, and away we go, or if others see it, they get to see what you're doing there. But I'll cover all this, and I answer the questions. In the afternoon video, I'm trying to anticipate what you'd be asking, and I talk to myself in it. So I'm not in the video like you see me here. It's my voice and charts that look this way. They're jet black, they're different, they have more studies than you see here. What's the cost of this? Because it is a cost. $8.95 to give it a 30-day trial. You don't have to stay with it. You can come to it. It's $16 every 30 days after that, and we will come up with 1-year subscriptions. But we've just started getting this launched now, and we're getting quite a few subscribers already. It's probably the biggest launch we've had in anything. How do you get to it and find out and sign up? Go to our website, www.iraepstein.com, under the word research. You'll see the drop-down menu. Click on Spider ETF video. What do you have to lose? $8.95? Maybe you'll get idea or two. That's the idea here. I'm Ira. You have a great day.